Greetings, Jonathan Camarda, your humble CIO. Hope you're doing well as you get ready for a great spring weekend, either baseball, golf, getting out on the water or on land, however you enjoy the spring. So I'll make this quick so you can get on to more, certainly more enjoyable endeavors. Well, it's been an interesting week on Wall Street, hasn't it? We started a week with Brainerd on the Federal Reserve there mentioning balance sheet tightening. So I did want to go a little bit into that to define that as the delineation between when the Fed certainly changes the rate levels there, as you saw on the last meeting when Powell increased by a quarter point, projected for a half a point in May. Brainerd was referring to the sales of Treasury securities from their inventories. So if you look at it that way, on an inventory basis, when the Fed sells securities, that actually tightens the economic picture, makes loans harder, capital flow slower. And post-COVID, when they loosened their belt, so to speak, right, they were purchasing Treasury securities, so they were taking them in, thus facilitating easier loans and credit movement and the such from that standpoint. So you can see when she talked about tightening the belt and sales of Treasuries off the balance sheet, that certainly adversely affects your more aggressive growth, sales-oriented stocks like technologies and discretionaries. And that's why you saw the hardest hit in those areas early in the week, right? Because again, going back to the dividend discount rate cash flow model, in the denominator is where the rate is factored in. And we all know the higher the denominator, the lower the outcome. And in this case, the outcome is your more aggressive stocks prices, right? So getting beyond that, wanted to also talk about, we referred to the inversion of the yield curve, albeit briefly last week. Digging a little bit deeper though, not as ominous, at least in the near term. So I did some peeling back of the onions, if you will, and looked at the 3-month to 5-year and the 3-month to 10-year spreads, and the 5-year usually pertaining generally to consumer loans and the profitability on them, and the 10-year on commercial loans and the profitability on them. Those continue to be pretty robust in an upward trajectory, meaning the 5 and 10 years are still well above the 3-month levels. So again, really until you see the inversion of the 2 and the 10-year, maybe 100 basis points or so, will it bleed down to the 3-month to 5-year and the 3-month to 10-year respectively? That's when you'll start to see some severe flattening and inverse characteristics that will certainly be a warning sign. Not there yet. Speaking of a bullish case, April's generally seasonally a strong month for the markets, and with earnings season perhaps taking the front cover from some of the macro events of Eastern Europe and certainly the supply chain concerns here. We shall see. Of course, the strongest sectors that you guys will notice you're participating in, and as well as we play the tilted chessboard to try to stay on the highest level, right, in these uncharted waters, at least in the last couple of years since pre-COVID, when the market took this kind of volatile turn. Healthcare, right, utilities, looking at agricultural food companies and some of your strategies, and some of the weaker sectors are, of course, technologies, and again, some of those more aggressive consumer discretionary names that had a nice run in March, but certainly have taken a step back here. In fact, when you look at the markets overall, technically, we don't always get too technical, but try to whip out the charter market technician hat every once in a while. So the S&P 500 is still above the 50 and the 200-day moving average pretty constructively, with the 50-day being above the 200-day, which is pretty important. NASDAQ, unfortunately not. Still the 50 below the 200, and the price action below as well, and even the Dow Jones not as attractive as the S&P 500. The good news is the S&P 500 is the largest of the indices and certainly more relevant than the Dow, so it is worth watching, however, that 2 of those 3 are certainly in negative territory. Now, May could be somewhat perilous with the, again, projected 50 basis point hike with Powell, but it's not guaranteed. There are a lot of folks, with the economy not being quite as strong as everyone says it is, thinks it still could be a quarter point, but it's very tough to see that with all the hawks flying around, like an Iowa cornfield with the Fed. When you hear Brainerd, who's generally a dove, right, speaks so hawkishly, so 50 basis points is still the highest probability. Question is, how much is that already baked into the mix? We shall see. We remain constructive through April with earnings and select sectors versus cash in this environment, as again, we see opportunities there. How long is the runway? We shall see. We'll remain eternally vigilant, and of course we take great pride in guarding over your wealth. If you have any questions with your personal wealth advisors, as I've spoken to many clients, very happy in the rear view with the tactical nature in which we've handled this. But if you have questions, certainly refer to PWAs, and we will try to address them here on these wraps. Other than that, It is a pleasure to serve as we appreciate your time, patience, and most importantly, your trust. Till next time, get outside, enjoy yourselves, try not to worry so much. It's the old line from that song, don't worry, be happy, at least for a couple of days.